Thank you, Manon, for recording. And please, everyone, type your name into the chat window for attendance so that we can keep track of that. And then when we have questions, go ahead and don't forget to type your name with your answer in the window so that we can prove that you were participating so that you can all get RCH credits for that. I'm gonna go ahead and share my screen. Can you all see it?
Yes.
Perfect. All right, so today and the next 3 days, we're going to talk about calculations of pay and calculations of deductions and net pay. So lots of stuff to talk about: regular pay, overtime, gross pay, income taxes, Social Security and Medicare tax, voluntary deductions, employer tax, gross up calculations, state income tax and railroad retirement, and involuntary deductions, as well as net pay. So all right, so calculation of regular pay, we talked about this a little bit last week when we were talking about just the introduction to payroll. But the calculation for an employee's pay requires many components: pay for time worked, pay for time not worked, overtime premiums, shift differentials or shift premiums, bonuses, and then of course there can be many other things that come into play here. Non-exempt employees' regular pay is calculated by multiplying the employee's pay rates by the number of hours worked and the number of hours for which the employee is paid but does not work. Exempt employees' regular pay is their salary for the pay period. And we'll do examples. All right, so for example, for a period covering 6 months or 26 weeks, Bill exceeded his production quota at Happy Time Toys and earned a bonus of $910. Bill worked 44 hours each week. His employer allocated an equal amount of the bonus to each work week and calculated the overtime due. So since he was given a bonus for a specific time frame in which he earned the bonus, then they had to calculate the amount for time that needed to be recalculated based off the bonus that he was paid for those hours. So the bonus allocated to each week is going to be the $910, and we're going to divide that by 26 weeks. So $35 each week. We're going to then decide how much of the bonus was for each hour worked. So we're going to take the $35 and divide it by 44. Since there was 44 hours worked each week, we round to 0.80 from 0.7955. I think that they recommend in the CPP that you round as you go to 2 decimal places. So keep that in mind when you're doing calculations. Luckily, they're not super mean in terms of when they give you a question, the answers aren't so close together that it could be a rounding issue. Does that make sense? So anyways, they're usually far enough apart that it's not a rounding issue. So his overtime premium rate for the overtime worked from the bonus is 0.5 times that 80 cents or 0.4. So for each week, we're going to give him 0.4 times 4 hours of overtime each week. We're going to give him $1.60 for each week for overtime times 26 weeks, and we're going to get $41.60. So just a little test tip, the overtime premium is 1/2 times the hourly rate divided by the per hour, and not 1.5 times the hourly rate per hour. So think of it as straight time plus premium. So you're going to figure out all of your straight time, which is going to be all the time for all the hours worked, and then you're going to add in your overtime premium, and it will help you get a right answer in the end. All right, tipped pay. So under FLSA, employers must pay tipped employees who receive at least $30 of tips during a month. We talked about that last week. They can pay them $2.13 per hour as long as the amount of the employee's tips is high enough to raise the employee's regular rate of pay to at least minimum wage for the work week. A pay rate of $2.13 per hour for tipped employees means that the employer can take a tip credit of up to $5.12 per hour with a $7.25 per hour minimum wage, which is the federal minimum wage, when the tips received by the employee are at least $5.12 per hour. Okay, so Kelly's Grill has employees who receive tips. The grill pays its tipped employees $2.13 per hour. During one work week, Monica worked 30 hours and received $80 in tips. So if we look at her hours, she worked 30 hours times $2.13 an hour. That's $63.90. She earned $80 in tips. Add those two together, we get $143.90. Her per hour rate, if we take that total, $143.90, and divide it by 30, because that's how many hours she worked during the week, we get $4.80. Is that high enough for minimum wage? Nope. So we have to give her some extra money. So now we're going to figure out how much money we're going to give her. So if we look at what she would have earned at minimum wage, which would have been $7.25 times 30, and then we subtract out what she actually made, the difference between those two is $73.60. So that's the additional pay we must give Monica to make it so that she earned at least minimum wage during the pay period, or the week, I should say. If you go back into that and you take the total amount of $217 and you divide it by 30, it does come out to $7.25 an hour. Therefore, you've checked your work and she's making minimum wage. A non-exempt employee's gross pay is based on the number of hours worked and the pay rates for the hour the employee works. So for example, Brent works in two different departments, A and B, at his company. In Department A, Brent is paid $12 per hour, while in Department B, he's paid $15 an hour. Brent works 25 hours in Department A and 20 hours in Department B in one work week. Brent's regular pay for the time worked, not including an overtime premium, is calculated as follows. So we're going to look at 25 hours times 12, which is $300. And then 20 hours times 15 is also $300. So his total regular pay is $600. And his regular rate of pay then would be 600 divided by 45, which is $13.33. So when doing an overtime calculation for this employee, you would use that $13.33 as his regular rate of pay to calculate his overtime. So that comes into play when an employee is earning multiple rates during the pay period. Piece rate. Piece rate is always fun. We have to figure out the regular rate of pay in order to be able to calculate the overtime premium. So under a piece rate system, the basic method for determining the regular rate of pay for piece workers is to add the weekly piece rate earnings to any other earnings worked for the work week, and then divide by the total number of hours. So for example, Jane works for Widget Inc., a company that pays production workers based on its units produced. She receives 52 cents per unit, plus a bonus of 15 cents per unit for all units produced in excess of 500. Jane worked 46 hours last week and produced 725 units. So let's look at how we're going to calculate her pay, including her overtime. So her regular pay, she did 725 total units at 52 cents a unit, is $377. Then she gets an extra 15 cents for any units that she produces over 500. So she produced 225 units over 500. So we're going to take 225 multiplied by that bonus of 15 cents, and that gives us an extra $33.75. So her total regular pay for the entire week is $410.75. She worked 46 hours during the week. So to get her regular rate of pay, we're going to divide that 410.75 by 46 hours. Her regular rate of pay is $8.93 an hour. So has she earned minimum wage? Yes, she has. So we're good. We don't need to pay her any extra to make up for that minimum wage. So now let's go ahead and calculate her overtime premium. So her overtime premium rate is going to be 0.5 times her regular rate, which we determined to be $8.93. So her overtime premium rate is $4.47 per hour. She worked 6 hours of overtime, so she worked 46 hours. So she gets $26.82 in overtime pay. Her total pay, we add her regular pay plus her overtime premium pay, and we get $437.57. Does it make sense when I'm saying to calculate all of her regular pay, then calculate her overtime premium and add the two together? Sometimes people they want to try and calculate everything less than 40 and then everything over 40, instead of splitting it out into regular pay plus an overtime premium. And I've just found you're more successful if you break it out into figure out all the regular, then figure out your overtime premium, add the two together. Salaried pay can be complicated depending on whether the employee is salary exempt or salary non-exempt. So to determine a salaried employee's gross pay, whether calculated in a manual check or producing a payroll check, we must figure out how to calculate the employee's regular rate of pay. So for example, Sandra is an exempt employee paid an annual salary of $45,000 per year, and she's paid that amount biweekly. So her biweekly pay would be calculated as her total annual wage, $45,000 divided by 26 biweekly pay periods in a year, and we would get $1,730.77. Commission pay. So an employer must include commission payments in an employee's regular rate of pay, even if the commission is not paid weekly, and even if the commission payment is delayed past the employee's normal payday or pay period. For the regular rate of pay calculation, the commission is allocated to the work weeks it was earned. So FLSA regulations say for a commission computation period of 1 month, you're going to multiply the commission payment by 12 and divide by 52 to get the amount of commission allocable to a single week. It is important that you all know that there are 52 weeks in a year. For some reason, I thought that was common knowledge, but some people don't know that. So take note of it. There are 52 weeks in a year. It is an important thing to know when you're doing payroll calculations. A non-exempt sales employee is paid weekly at $9 per hour. He receives 4% commission on net sales paid the month after the sale. Last month, the employee had $16,000 in net sales and worked 48 hours during 1 week of the month. So to calculate the regular rate of pay, we're going to take 25% of the commission that he would have earned. The reason we're going to do 25% is because we are taking the commission he earned for the whole month and we're dividing it by 4 because there's 4 weeks in a month. So we're going to take 25% of the commission and we're going to allocate it to each week. So he worked 48 hours, they told us, at $9 an hour, which gives us $432. His sales commission for the whole month was $16,000 times 4%, which is $640. We're going to take 25% of that because we're only allocating to a single week in the month. So that gives us $160. So his pay for his regular time plus his piece of the bonus that's being allocated to that week is $592. So to figure out this guy's regular rate of pay, we're going to take his $592 that he earned during that time and divide by the 48 hours he worked. His regular rate of pay is $12.33 an hour. So if we needed to go back and calculate any overtime that he was owed for that, which we probably would because he worked 48 hours in that week, we would use $12.33 as our regular rate of pay, multiply that by 0.5, and then multiply that by 8 because there was 8 hours of overtime in that week. Does that make sense? Cool. All right. All employees covered under FLSA must be paid at least 1.5 times their regular rate of pay for all hours worked over 40 in a single work week. We know that from last week. Again, to calculate regular rate of pay, we're going to take their total regular pay and we're going to take it and divide that by the total number of hours worked. Very important that we're only dividing by hours worked. If they took off for vacation, we're not including those hours. If they took off because they were sick, we're not including those hours. Any time that they are working is those hours that we're going to divide by. Okay. We talked about all this last week. What should be included? Don't include, paid time off, gifts, things like that. Those are not being included in your regular rate of pay. So if Jerry worked 35 hours in 1 week, 38 hours in week 2, and 44 hours in week 3, although Jerry averaged 39 hours per work week over the 3-week period, he is entitled to overtime pay for week 3 because he worked 44 hours. My first job was at a golf course, and my boss thought it was really nice to work you for 60, 70 hours 1 week and then 5 hours the next week and not pay you overtime. I was young and dumb and didn't know any better. I should go back on him now. But anyways, it's per work week, not per pay period. So my boss, he said, nope, I pay you biweekly. So it's 80 hours every 2 weeks that you get overtime. Nope, that's not how it works. It's per week. I wish I would have been smarter back then. Sam receives a holiday bonus of $50 from his employer. This is not going to be included in his regular rate of pay. Why? Any ideas?
It's not hours worked.
Perfect. It's not for hours worked. So we're not going to take that. It's not a discretionary, I'm sorry, it's not a non-discretionary bonus. It was a $50 holiday bonus. So we're not including that in his regular rate of pay. His regular rate of pay was $10.50 per hour. He worked 45 hours during the work week. So his regular pay was $472.50. His overtime premium pay is going to be $10.50 times 0.5. So we're finding that overtime premium, which is $5.25. And then we're multiplying by 5 to get $26.25 in overtime premium that he is owed. So his total gross pay for the week is going to be $472.50 plus $26.50 in overtime premium plus his $50 bonus. We talked about this last week, so I'm not going to go into it in big, deep depth, but if your employer pays you some sort of premium for working on a Saturday or a Sunday or a holiday, that can be used to offset any overtime that you're owed for the week because you're being paid at that premium rate. And it has to be at least 1.5. But if your employer does something really nice, like you get double time for working on Sundays or something like that, that's above and beyond. So it can be used to offset any overtime you're owed for the week. From last week, there are certain employees that have a special overtime rule. It's called 8 and 80. And anybody remember who gets to use the 8 and 80 rules, where you have to work?
Hospital.
Hospital or nursing home. Good job. All right, so we're going to go back to talk about calculating overtime for an employee that works different hours at different rates. So we're going to call this overtime using a weighted average. So calculate overtime for Larry, who was paid a shift differential for working different shifts. So on Monday, he was paid $10 an hour for working 8 hours. Tuesday, $10 an hour for 9 hours. Wednesday, he got $11.50 for working 8 hours. Thursday, $12.50 for 10 hours. Saturday, $10 an hour for 8 hours. He worked a total of 43 hours for the week. Therefore, he does have to be paid some overtime. So we need to figure out how much overtime he's going to be paid. So his regular rate of pay, if we take all of those different rates times all of those hours he worked, we get a total of $467. Divide that by 43 to figure out his regular rate of pay. So in this case, his regular rate of pay is $10.86. We're going to multiply that by 0.5 to figure out his overtime premium rate. And then we're going to take that overtime premium rate of $5.43 and multiply by his 3 hours of overtime. And his overtime premium pay is $16.29. So to get his total weekly compensation, we're going to take his regular pay, add it to his overtime premium. If you remember nothing from today or the next 2 days, remember that to calculate a gross paycheck, you're going to find the regular pay, you're going to find the overtime premium, and you're going to add the two together. That's huge. Apparently, I just gave you the answer to that one because my animation didn't work. Anyways, so we're going to calculate pop quiz. Make sure you put your answer in the chat with your name. Calculate the regular rate of pay for a non-exempt employee who works 30 hours at $10 per hour and 20 hours at $15 per hour in 1 work week. So I have my handy dandy calculator. We're going to do 30 hours times 10. And we're going to do 20 hours times 15. And we're going to add the two together, which gives us 600, and divide by 50. And we get 12. Everybody with me there?
Yep.
Good job. You guys are awesome. All right. So let's look at a salaried non-exempt employee. So a salaried non-exempt employee means that they are paid a salary, but they also get paid overtime if they work over their normally scheduled hours. So we are going to figure out Bill's weekly salary is let's see, Bill works 40 hours per week and is paid a monthly salary of $3,200. So let's figure out what his regular rate of pay is going to be. So he gets $3,200 per month. So we're going to multiply by 12 because there's 12 months in a year. So his annual salary is $38,400. In 1 year, Bill is scheduled to work for 2,080 hours because he's worked 40 hours a week times 52 weeks in a year, which is 2,080 hours. That's an important number. If you don't know that number, that's a good one to keep memorized. So to figure out his regular rate of pay, we're going to take his annual salary, divide that by those hours that he's going to work in the year of 2080, and we're going to get $18.46 per hour. Again, that is rounded. Does everybody know rounding rules? I should have asked that. 5 or up, you round up. 4 or below, you keep it the same.
So that hasn't changed over the years then on the rounding
Nope.
policy for federal. Okay.
Correct. We try and keep some things the same. All right. So again, if you're a non-exempt salaried employee, you are scheduled to work some sort of set hours per week. And if you work over those set hours per week, you are due an overtime premium. So for example, if you are a salaried non-exempt employee and you are scheduled for 35-hour weeks, but you work 38 hours in 1 work week, you actually get 3 hours of overtime pay. I'm sorry, you get 3 hours of hourly pay above and beyond your normal 35. Since it's not over 40 though, you don't get overtime pay. Does that make sense? All right, so let's look at a salaried non-exempt person and overtime pay. So Sarah is paid semi-monthly and she gets $2,000 semi-monthly and she works 35 hours per week. So if she's paid semi-monthly, she's paid twice a month. There are 12 months in a year. 12 times 2 times per month is 24. So she's going to earn $2,000 24 times a year. So her annual salary is $48,000 a year. She is scheduled to work 35 hours a week. So 35 hours times 52 weeks in a year is 1,820 hours. So her regular rate of pay is going to be $26.37. We're going to take that 48,000, divide it by the normal hours she's scheduled to work in a year, 1,820, and get $26.37 per hour. So Sarah, from our example, she works 42 hours in 1 work week. She must be compensated for those hours over 35. So let's look at this. We've already figured out her regular rate of pay. It's $26.37 per hour. She worked 7 hours above and beyond her normally scheduled 35 hours a week. So she gets 7 extra hours at her regular rate of pay. Now, 2 of those hours happen to be over 40 in a work week. So she gets 2 hours of overtime premium. So her overtime premium rate is going to be her normal regular rate, which we already figured out at $26.37 per hour, multiplied by 0.5. That gives us $13.19. That's her overtime premium rate. 2 hours of overtime premium gives us $26.38 in overtime premium. And to get what she's going to get paid for this 1 pay period, or this 1 work week, I should say, work week, she's going to get her $2,000 salary plus $184.59, which was the additional pay for the 7 hours at straight time. And then we're going to add in her overtime premium pay of $26.38 for the overtime premium portion. Questions on that one? So 5 of the hours she got paid just her regular rate, but for 2 of the hours she got paid her regular rate plus her overtime premium, because there was only 2 hours that were over 40 in the week. One of several of us that are on this call that have taken the CPP in the last few years did see a question similar to this on the exam. So be careful and make sure that you understand which hours need to be calculated at straight time and which hours need to be calculated at overtime per federal law. Okay. Also keep in mind that states have stricter laws or can have stricter laws. Not that that's necessarily going to be a question on the test, but just keep in mind for your own purposes. Okay, So this is kind of a long example, but I wanted to go through it. So the FLSA requires overtime to be paid on commission earnings for non-exempt employees who work more than 40 hours in a week in which the commission was earned. So let's take a scenario. Mike is a non-exempt employee who is paid $9.50 per hour and receives a 4% commission on net sales orders. Sales commissions for the prior month are paid in the first payroll of the following month. Sales amounts can be calculated only on a monthly basis and are allocated equally to each week in the month. So last month, Mike's sales were 10,000. He worked 45 hours during week 1, 40 hours during week 2, 42 hours during week 3, and 50 hours during week 4. He has already been paid for his hours worked last month. His employer now needs to calculate his overtime based off of the commission that he's now earning. So looking at the weeks that he worked, which weeks do we need to recalculate overtime for?
First and fourth.
First, I agree. He worked 45 hours. Fourth, he worked 50. I agree.
About 42.
Third.
And
Third
42.
week.
We also need the third week. We don't need to relook at week 2 though. He didn't work overtime. He only worked 40 hours. So week 2 we can ignore, but week 1, 3, and 5, or 1, 3, and 4 we need to look at. So let's look at week 1. So his overtime premium rate, we're going to take his regular rate of $9.50 times 0.5 is $4.75. He worked 5 hours of overtime. He gets $4.75 for those 5 hours. That's $23.75. That's what his regular overtime premium would have been without the commission. Now, we're going to take his regular rate of pay, or his regular pay, which was 45 hours times $9.50 at $927.50. We're going to take his commission that's allocated to that pay period, which is going to be $100. That's his $10,000 times 4% times 25%, because that commission is being allocated evenly to each week in the month. So we're only taking a quarter of it for the first week. So that's $100. So his regular pay for week 1 was $527.50. He worked 45 hours. So we're going to divide that by 45 to get $11.72 to get his regular rate of pay for week 1. So his overtime premium is now $11.72 times 0.5, which is $5.86. He worked 5 hours, which means he gets $29.30 for his overtime premium pay for the week. He was already paid $23.75 of his overtime because he was already paid the overtime portion for the $9.50 an hour that he was working. So we only owe him the difference. We only owe him $5.55. Does that make sense?
Yeah.
Cool. Week 2, we're going to ignore because he didn't work over 40. We don't have to do anything with it. Week 3, we're going to look at the similar idea. So he worked 42 hours. He's going to get $100 allocated of his commission to that week, which means his total regular pay for the week was $4.99 divided by 42 hours. He gets $11.88 as his regular rate of pay, times 0.5 to find his premium rate. $5.94 times 2 hours is $11.88. He was already paid his overtime rate for the regular hours that he worked at $9.50 an hour. So if we take the difference between his overtime premium that he should have gotten and what he's already gotten, we owe him an additional $2.38. Similarly, for week 4, he worked 50 hours. So if we allocate $100 of his commission to that week, he gets $5.75 for the whole week. Divided by his 50 hours is $11.50 per hour for the week. His overtime premium rate, we're going to multiply by 0.5, we get $5.75 times 10 hours of overtime, $57.50. He was already paid his overtime premium rate for the regular time that he worked. So we've already paid $47.50 of it. So we owe him the difference between the two of $10. So if we add all 3 weeks together of what we owe him in additional amounts, he gets $17.93 in additional pay based off of that overtime calculation from adding in his commission. Bottom line, it's a pain to go back and recalculate overtime when you add in commission. Piecework, again, let's talk about, there's a couple different methods to do piecework. So let's look at this one. Brad receives $1.75 for each doll he assembles, plus 25 cents bonus per doll for each doll over 352 he assembles in a regular 46-hour work week. In one work week, Brad assembles 420 dolls. So his regular earnings are 420 times 175 is 735. He produced 68 dolls over the 352 doll limit to get the extra 25 cents. So that's an extra $17. So his total piecework earnings for the week is those two things added together, or $752. We divide that by 46 hours. He gets $16.35 per hour for his regular rate of pay. His overtime premium rate then is multiply that by 0.5. We get $8.18. He worked 46 hours, so we have 6 hours of overtime premium that we owe him for, which is $49.08. So his total earning for the work week is $752 plus $49.08, and he gets $801.08. Again, figure out his regular earnings, figure out his regular rate of pay, multiply by 0.5 to get your overtime premium, multiply by the hours of overtime, add them up together. Concept is the same. Again, I talked about this earlier, but round as you go on your calculations, it'll make you more accurate when you get to the answers at the end. Most of you know, used to be a math teacher, so I have this really fancy calculator, and it gets me in trouble because I don't round as I go, because this fancy calculator saves all my answers. So by the time I get to the end, sometimes I'm $1 off or so because I don't round as I go. So don't do what Melissa does. All right, second method for calculating overtime for piece rate. Sally receives $3.50 for each figurine she paints and $5.25 for each figurine she paints after working 40 hours in a work week. In one 45-hour work week, she painted 140 figurines in the first 40 hours and 18 in the next 5 hours. So her regular piece rate earnings are 140 times 350, which is 490. Her overtime piece rate is 350 times 1.5 or 525. Her overtime piece rate earnings are 525 times 18, so 94.50. And then her total earnings for the work week are 490 plus the 94.50. Add those two together, we get 584.50. Her total regular rate of pay, if we take that and we divide by 45, is $12.99. So she gets $12.99 per hour for regular rate of pay. Is she over federal minimum wage? She is, so she is good to go. Oh, good, I didn't put the answer on this one. A non-exempt salaried employee is paid $2,000 per month and normally works 40-hour work week. However, in this work week, the employee works 45 hours. So we need to calculate the employee's gross pay for the week. Again, this is a non-exempt salaried employee. So I'll give you a couple minutes to do some math. You guys are awesome. Good job. Some of us were a few cents different with our rounding, but that's okay. Like I said, the CPP exam is not mean enough that they don't make them so close that you can't determine which one you're closest to with your rounding. So great job, you guys got it. Regular time plus overtime premium. That's the bottom line for how to figure out gross pay. All right, a few things that we need to know. Final pay. Final pay is generally due by the next regular payday under FLSA, and an employee must be paid for all earned and unpaid wages from the end of the previous pay period and the last day worked. As normal, those wages are subject to withholding. And as a general rule, you may not withhold final pay for any reason. I'm going to tell you right now that most states, if not all states, have more strict laws than this. Most of them have to be paid within a certain time frame. They have to be paid in a certain method, all kinds of stuff. So at the federal level, it does you can pay them on their next payday, but at the state level, it may be more specific than that. Taxable wages. Internal Revenue Code 61 defines taxable wages code as all compensation an employee receives that is not specifically excludable from taxable income by law. Because of this requirement, fringe benefits are taxable in many cases. So one thing that's super popular in our area right now, and Michelle, this doesn't really apply to you. I mean, I'm sure you have something similar in your area, but we have what we call Appleton Clinics, and Appleton Clinics is not considered health insurance. But many employers like to pay for this or a portion of this on behalf of their employee. It is not health insurance. And because of that, it is a taxable fringe benefit. So if your employer is paying that for you as the employee, a portion of your premium, any of your premium, that portion that they're paying to you is, or they're paying for you, is taxable income for you. So that's a good example that I like to use because there's a lot of employers in our area that like to do that for their employees, which is absolutely awesome, but it does need to be included in taxable income for those employees. It's similar to a gym membership. So constructive receipt or constructive payment is an interesting concept. Regardless of the date printed on an employee's paycheck, the date that triggers the employer's withholding and deposit obligations is the date the paycheck is actually provided to the employee. So we have I know of some people, some clients, some employers that like to give out their checks early. So they're dated for a certain day, but they're dated for Monday, but it's the weekend and I have them ready. So I'm going to give them to you on Friday. Well, if the check is dated for Monday, but I hand it out to the employee on Friday, that's the date of constructive receipt. If the employee is able to take that to the bank and get it cashed on Friday, that's the date of constructive receipt, which means that's what's going to trigger the date for which the withholding that you as the employer have collected is due. So if you're a semi-weekly filer for federal and you pay somebody on Friday, taxes are due the following Wednesday, pending that there's no holidays or anything crazy. Or if it's over $100,000, it's due on Monday. But if it was not paid until Monday, it wouldn't be due until the following Friday. So you can see the difference in that. So you want to be careful. Make sure that what's the date that's printed on the check is the date that is actually given, the check is provided to the employee. So as an example of constructive receipt, George was out of town on July 1st, which is a biweekly payday, because of a business meeting with a client that had lasted longer than expected. His check was kept at the office until his return on July 5th. Because his wages were made available on July 1st, they were constructively paid to George on that day, and his employer was responsible for withholding any applicable taxes at that time. So he couldn't get to the check, but it was there. It was available to him. If he had been in town, he could have went and got that check and cashed it. So July 1st is the date that's going to go down as the constructive receipt, and that's the date that's going to trigger when the taxes are due. On the other hand, Maureen is scheduled to receive her last paycheck of 2020 on Thursday, December 31st. Her biweekly wages are $4,500, and she has paid an excess of the Social Security wage base limit. And this has a wage base limit of 2020. Be careful, but it's still a good example. So because of system problems, Maureen's employer is unable to issue the paychecks until January 4th, although they are dated December 31st. Maureen is not constructively paid her wages for withholding tax purposes until 2021, when her previous earnings for that year are zero. Therefore, the entire $4,500 wage payment is subject to Social Security tax at the 2021 rate. So that is a situation where there was a system problem, checks couldn't be issued for whatever reason, and they had to be pushed until the 4th of January. Because of that, the payment that she received, the $4,500 payment, if she had actually received it on December 31st, it would not have been subject to Social Security, but because it didn't get paid out until January, it was subject to Social Security. Okay, so make sure that when the pay is actually made available to the employee is when the taxes should be, number one, calculated, and number two, that's the date that triggers when those taxes are due. Imputed income. So imputed income represents the value of the benefits employees receive from the employer and must be included in the employee's income. In most cases, employees do not receive cash as a benefit. Employers are required to impute income to employees for each taxable non-cash benefit received by the employee. So this is like the Appleton Clinic example that I was talking about. Okay. So to calculate net pay when a non-cash fringe benefit is included in income, you must add the dollar value of the benefit to the employee's taxable gross and then calculate the taxes. So for example, an employee has $50 included in income for a non-cash taxable fringe benefit. So that Appleton Clinic that I was talking about, if your employer pays $50 of the premium for you, this could be the perfect example. The employee's salary is $1,500 for the monthly pay period. So to calculate the taxes, we would take their $1,500, we have to add the $50. So their taxable pay is $1,550 instead of just $1,500, even though they're only getting $1,500 in their pocket. We then calculate the taxes after that $50 has been added to their taxable income. And then we calculate all the taxes, and their net pay is different in those cases because the taxes are higher when the $50 was included as a taxable fringe benefit for them, even though they're not getting it in wages. Does that make sense? Perfect. Okay, federal income tax withholding. So what time is it? 12:45. Do you guys have time to stay till 1, or do you want to wrap it up? I'm good either way.
I am good either way.
I say go for it.
The phone's not ringing in our office at this point, so I'm going to keep talking for a little bit.
Hey, Melissa, while we're kind of interrupted, Dolby ladies, if you want your RCH credit, can you go ahead and just type everybody's name into the chat that's present in your conference room?
Perfect. So in 2020, the IRS changed federal withholdings as we know it, and they changed the way that we have a W-4 and all of that stuff. So we're going to look at the withholding tables and how to calculate federal income tax. I will tell you, be prepared to manually, by hand, calculate federal income tax withholding on the CPP or the FBC exam. I will tell you it's on there using both the wage bracket method as well as the percentage method. The optional flat rate method will also be on there as well, and the mandatory flat rate method will also be on there as well. So we're going to talk about each of them, but just be aware that they are in fact on there. So this is the worksheet, and they do provide you this worksheet, but I would be very, very familiar with it so that you can calculate withholding by hand when needed. So basically what's going to happen with all of these is you take the amount that the employee is making on the particular pay period, you annualize it. So you're going to blow it up and pretend that if they made this amount on every single payroll for the entire year, this would be their annual income. So you're going to blow it up and you annualize it. Once you get it annualized, you're then going to take it back down to what it would be per pay period. So that's really what you do. You start with their taxable wage for the current period, annualize it, figure out all their deductions, then shrink it back down to a per pay period example or a per pay period amount. So
And do you annualize it whenever they say wage bracket method, or do you annualize it for the percentage method and all of the different methods?
you will annualize it for both. Good question. And we'll look at examples of those, but okay. So for example, Sonia receives $1,340 in taxable wages on a weekly basis. She claims married filing jointly with no other adjustments on her 2020 Form W-4. The wages paid in 2021, look at the table for weekly payroll period under worksheet 2 from publication 15T, which we've included on this slide for you. Then find the appropriate wage bracket, which happens to fall between 1,335 and 1,345 for married filing jointly. Standard withholding, the proper amount to withhold is $95. So we look at this table, we find where she fits. So she claimed married filing jointly. The standard withholding for her, because it doesn't say that she has the checkbox in step 2 checked. So we're looking at the standard withholding. We find her wage bracket and we get that to be 95. Okay. Okay, so this one is daily. So if you were to calculate taxes on a daily basis, which I'm going to tell you is not very common, but could happen. So Jack worked 3 out of the last 7 days and he earned a taxable income of $385. On his 2018 Form W-4, he claimed single with no allowances. Assuming the payroll period to be 7 days, we're going to take the $385 that he earned and divide it by 7 to determine his average daily wage of $55. Then we're going to take this worksheet that we have on there for you, and we're going to find the daily wage rate of $55. He is claiming no allowances. So we're looking at the 0 allowances column. We're going to find his rate. And we're going to say that it was $3.70. And then we're going to multiply that by the number of days and get $25.90 to withhold from his check. So here's where we're going to look at this worksheet that I was talking about, where you take their wage that they're earning on this pay period, you blow it up, you annualize it, and then it comes back down and we're going to do a per pay period. So this is the last example we'll do today, and then we'll pick back up tomorrow. So down in the corner, an employee earns $1,775 semi-monthly and claims head of household with 1 qualifying child under the age of 17 on 2020 Form W-4, which means he entered $2,000 in step 3 on his Form W-4. That's what the 1 child under 17 means. So using the wage bracket method, we're going to calculate the employee's semi-monthly federal income tax withholding. Okay. So step 1, up in this worksheet 2 that I have in the upper left-hand corner, is we're going to enter the total taxable wages for the pay period. So 1,775. 1B, we're going to enter the number of pay periods per year. So they say he gets paid semi-monthly. So that means we're going to put 24 on line 1B. Line 1C, we are going to multiply, 4A, sorry, 4A from the employee's W-4. He didn't have anything on 4A. So we're going to keep that as 0. Okay. Then we're going to take, enter the divide. Oh, so 1C is also 0 because we're dividing 1B, 1C by 1B. Then we're going to add lines 1A through 1D, which is just going to leave us at 1,775. And then step 4B, they didn't tell us anything, so we're going to assume that that's 0. And then we're going to divide the amount on line 1F by the pay periods in 1B. Again, that was 0 as far as we know. So his adjusted wage amount is going to be $1,775. I guess I lied to you, man. And I guess they don't have you annualize it on this worksheet. Sorry. I thought they had you annualize it on all of them. I guess with wage bracket, they break it down so you don't have to annualize it. That's my fault. Okay. So we're going to figure out. So if you look at that line on the wage bracket method, so it's going to be the line between $1,770 and $1,790. Move to the head of household column under the standard withholding to determine his tentative amount of $109. And then in step 3 of this worksheet, we're going to figure out his credits. So in step 3, you talk about the $2,000 that he had for his dependents, and you're dividing that by the number of pay periods that he is scheduled to work. So that's 24 in his case. And so we're going to take his $22,000 annual kid allowance, divide it by 24 and get 83.33. So normally we would withhold 109 based off of the line on the wage bracket method, but we're going to take 83.33 away from that because of his kiddo, and we're only going to withhold 25.67. Does that make sense? All right, so the next one that we have is a percentage method, but I think we'll wait for tomorrow to do that one because it's a little bit longer. Questions, concerns, words of wisdom, rude gestures? So they give you the worksheets, as far as I'm aware, they give you the worksheets as resources on the CPP exam. So my suggestion is obviously to be familiar with them. But as long as you read them and follow them, you'll be fine. Just write the numbers down as they give them to you.
Yeah, thanks. So so just going back, so just to confirm, they gave us enough detail that we didn't have to annualize it.
Correct, yes. And they gave us the wage bracket method, which had it at a per pay period amount. So the percentage method, I guess, is where more they do the annualization, and that's more common.
We'll see that tomorrow. Okay.
So that's, yeah. And that's the other thing with the new W-4, that's the whole point, is it's an annual form. So you're saying $2,000, that's an annual child credit. That's not a per pay period child credit. So that's why I say that they annualize things. So yeah, we'll look at it tomorrow, but they do give you enough information. And if they don't specifically say that they marked a box on their W-2, then you have to assume that they didn't mark the box. That's the one thing that's a little bit tricky. All they told us was that he's claiming head of household and one child. They didn't say anything about the checkbox in step 2 or anything in step 4 of the W-4. So we just have to assume that they did not check those boxes and they did not put anything in step 4. If they put something in there, then they'll have to tell you that they put something in there. Otherwise, we can't make that determination.
Yeah, that's good. Makes sense.
Like I say, we'll look at a lot more examples tomorrow. Okay.
Thank you, Melissa.
You're welcome. Thanks, guys. Talk to you tomorrow.
See ya.
Yeah,
Bye.
thanks.
Yeah, bye.